economic case for rolling out another 50 basis point hike. The Fed raised rates by 25 basis points last month, stepping down from 50 basis points of increases in December. Yussef Gheriani is Director for Investment Operations at IHT Wealth Management. He joins us from Chicago today. So Yussef, just looking at what's being floated, it looks like 50 basis points is back on the table. What is your sense of whether we're really going to see that at the next meeting and how bad that would be for equities?
So 50 basis points, whether it's 50, 25, we're not super concerned about it one way or another. I think the more important question investors need to be asking themselves is, where are we going to go over the course of the next 6 to 12 months? And kind of what does that peak look like? Is it 4.75? Is it 5? Is it 5.25? Those are all in play, and those are all in a range that I think most fixed income investors can handle. What would be outside the box, something that's really kind of unexpected and what would really hurt for fixed income investors and for the economy as a whole is if the Fed has to go higher than that, if they have to go to 6.5. That's the kind of, those are the areas that are scary and that we're not entertaining and we hope we don't have to see. So, 50, 25, not super concerned one way or another. It's going to be fine.
I take your point about the peak rate, but there has been a bout of data this week, producer prices, consumer inflation numbers, retail sales, all this coming in hotter than expected and raising the concerns that inflation is really becoming stickier, entrenched in the American economy. Is there a fear that the longer the Fed takes to tame inflation and destroy demand, the more complicated this is?
The Fed's hands are tied in a way. A lot of what they're fighting against is not just inflation, but inflation expectations. And inflation expectations are largely caused and driven by food prices, by fuel prices, by things that are more volatile that they don't have a great handle on. And then additionally, a big part of the inflation fight for them has been the price of housing, of shelter. And there's a housing shortage here in the United States, right? We've underbuilt for a very long time, since the great financial crisis. And unfortunately for the Fed, raising rates it slows down the building of new homes. It slows down construction. So they need to do it in order to tamp down inflation expectations. But at the same time, they're also making it harder to bring some of these things to market that might help inflation over the long term. So kind of taking all that and zooming out, are we worried about inflation staying high? No, inflation's going to come down. A lot of this is lagged, okay? But the reality is that it doesn't come down all at once. It's not a 5-month thing, a 6-month thing. People calling for the Fed to cut before the end of the year, we think that's unlikely. And the Fed definitely wants to make sure that they beat inflation the first time. They don't want to do the Volcker version of this where you got to keep on hiking and keep on raising rates up and up and up, right? Pause, hike. No, they want to do it in one bout. Hike, beat inflation, and then start bringing rates back down.
Okay, in the meantime, as price pressures remain elevated in the next few months, as you raise, what is that going to mean for the sectors in the stock markets that are getting hit by these price pressures, whether it's from wage costs or consumers spending less because things are more expensive for them?
Wage costs are a huge deal. I think anything that has large wage exposure, especially some of your more consumer staples names, are probably at risk. Whereas on the other side of the coin, if rates are going to be higher for longer, take advantage of that. Buy things like banks. Buy the financials where net interest margins are just going to stay high and they get to, it's free money for the banking systems, right? People have deposits, they take that, they get the interest, and the banks don't pass it all through. They keep some of it. So if rates are high, that's the place to hide, right? And they don't have the same wage pressures as perhaps something like a Starbucks does, where they've got to keep on raising wages for all of their employees, or somebody like Walmart, right, who's got to keep on raising prices. So elevated inflation, that raises prices, it raises revenues. Not super worried about companies from a revenue perspective. It's really more about, can they keep those labor costs under control? Can they keep some of those other pressures that would impact their bottom line? Can they keep those under control?
Yussef, just very quickly before I have to let you go, what is your view on tech now?
I don't rule them out. Don't count them out. They've never focused on trying to boost their margins up and being efficient with their capital. It's always just been growth. Now everybody wants them to really start contributing to the bottom line. I wouldn't bet against them. They're great at executing. They're great managers. I would not bet against them boosting their margins and boosting the bottom line. So don't count them out.
Okay, so point taken. Thanks very much for sharing your insights with us. Yussef Gheriani is Director for Investment Operations at IHT Wealth Management.